All right, how you doing? Welcome into the Multifamily Millions live event. I want to thank you so much for being here, uh, taking a few minutes or a little bit of time out of your Saturday to be here with us to kind of go over. If you're interested in apartments, you're trying to learn, hey, look, how do I buy rental property in general, but more importantly, apartments. And what we categorize as apartments or commercial real estate is anything 5 or more units. So if you're buying a single family home, duplex, triplex, or 4 unit property, technically that falls under residential real estate. Okay, no different than buying a single family home. Anything under 4 units classifies really as residential property. Things are changing with that due to some recent loan changes with Fannie and Fannie Mae, Freddie Mac. Anything in the duplex, triplex, or fourplex type properties where you can actually get commercial financing on them now. But realistically, for today's purposes, anything 5 or more units is really what we're talking about. And I'm going to show you several things today, but more importantly, why and how it's easier for you to buy a 5, 8, 10, 15, 20 unit apartment building in your area easier than it is for you to go buy a single family house, and why the benefits are there for you to do so versus buying rental properties and single family homes. Okay, I'm going to show you why this is better. Then I'm also going to show you that by doing so, what do you make from it? Like, if I were to do this, how lucrative is it for me to do this? And why would I do this versus doing other types of real estate? So that's what we're going to go through today. It's going to take about 35 to 45 minutes of time here, but I'm going to walk through several different aspects of how you buy apartments and the different categories of them. And then that way, if you have any questions, obviously you can go into the chat and do so. But this should be very informative for you. And then by the end of it, look, if you're interested in diving in deeper, getting mentorship, stuff like that, we'll give you a chance for a free strategy call if you choose, not obligated, if you choose to do so by the end of this presentation. So here we go. Let's jump right into it. So without further ado, let's pull up how you buy apartments. And just FYI, first 30 seconds here, who am I? So my name is Justin Brennan. I'm born and raised San Diegan. Currently own about $110 million of assets in 5 different states around the United States, about 500 plus apartment units that are built into that. But I didn't start there. I mean, we literally started with a $100,000 condo in Southern California in the midst of the financial crisis, $25,000 down, got a $75,000 loan. And then from there, got into duplexes, triplexes, 4 unit properties, graduated from that into the 5 to 10 unit space, graduated from that into the 20 to 50 unit space, then graduated from that into the 100 plus unit space, which is where we're at today. So we started with nothing. So for somebody to say, hey, how do you get from there to there? I'm going to show you. I'm a perfect example of it, exactly how you would do it and why you would do it and the benefits of doing that. So that's my quick background. But grew up in real estate a little bit with family, more in the construction side of it, not so much in this apartment game, but then learned a little bit of it through. But I had to learn all this stuff too. I had to get mentored. I had to go get educated and pay for that stuff because it's extremely valuable, extremely valuable. And once you understand it, look, single family game, you're dealing with 6 figures. Awesome, can make fair money with it. But it's also very transactional. You want to go flip houses? Transactional. I'm saying that, you do it because you actually get kind of quick burn and turn money, kind of get some capital in your pockets. But if you're trying to really move the needle for yourself and get into some big money stuff, apartments are where it's at. Right? Nothing's truly passive, right? They always say, I want passive income. Yeah, apartments are, once they get up and running and stabilize, you definitely step away from them and they're less active, but nothing's truly passive income. So when they say that, they're giving you a grand facade, but it is closer to passive than anything else. And you're making money while you sleep. That is very true. So I'm going to break everything down. So process for buying apartments. Doesn't matter how you do it, whether you're going to buy a duplex or you're going to buy a 100 or 200 unit apartment building. Doesn't matter. You will literally follow this exact same process. First, you got to find the deals. That's everybody's biggest thing. How do you find the deals? We're going to go through that real quick today. How do you analyze them? We're going to go through that really quickly. And we have actually pro formas and stuff. If you come to some of our programs or download some of the free info we have deal analyzers for you that you can get. How do you raise the capital? Because a lot of times people get stuck with, well, I don't have the money. I totally understand that. And I'm going to show you exactly how I did it. When I got started, I was getting my butt kicked. I was in residential real estate at the time, 2008 financial crisis. I didn't have any money. I was getting hammered, right? The market's tanking, financial crisis. So I didn't have any money to put into the deals. I'm going to show you how I leverage this and my talents to get with somebody that did. I'm going to show you how you can do it too. How do you raise the capital? Closing escrow on the deal properly so you don't get yourself into a money pit. Proper due diligence, as they say, right? From doing physical inspections on the property to financial inspections on the financials to make sure you're getting what you think you're getting, okay? And then lastly, once you've closed escrow, how do you manage the deal, right? How do you put in a property management company? How do you manage the management company? So how do you do all of this stuff? But this is the process for buying apartments. And I'm going to continue to reference this throughout this morning so you understand that this is it. I'm trying to simplify it. 5 things. It doesn't matter how you do it. It's still 5 things. So really, really, really important. So what I want to do here now is I'm going to break down a potential deal, right? How you would look at it from financially, equity in the deal, and some pro forma numbers, et cetera. So I'm going to actually pull it up on the screen so that way you can see it in real time, and we're going to go through it, okay? So give me just a minute here. I'm going to share my screen. So real quick, this deal that I got pulled up right now, this is a classic deal. This is in Huntsville, Alabama. Nothing sexy. It's like, I believe it's a little 10-unit deal, okay? In Huntsville, Alabama, called the Garden Grove. They're asking $625,000 for it, okay? $625,000. And very reasonable for somebody to be able to purchase something like this. And how you would do it. What do the numbers look like? Okay, what do the numbers look like? So let me stop sharing real quick. And I'm going to show you financially, and then I'm going to pull up the pro forma, the underwriting for it to show you how it would look, okay? But this is how the numbers would look, generally speaking, if I wanted to go buy this thing. Okay, you go buy this thing. All right, here we go. Purchase price, $625,000. I'm going to come in here and I'm going to get a 65% loan. I'm going to show you how these numbers work here in just a minute. 65% loan from a local commercial bank. Now, getting this loan is easier than you getting a home loan on a residential property. And the reason why is because when you get a residential home loan, you go buy your home, the bank is underwriting you personally, your financials, your bank statements, your tax returns, your everything, because they want to make sure you can personally pay them back. Big difference. Move to commercial real estate, 5 or more units, the bank is underwriting the property, okay? They don't really care as much about you, right? You're secondary in the process. They look at the property and the property's abilities to pay them. So that way, if you can't, bye-bye you, we get the property, we run, rock and roll. Property's going to handle it. You're less with it. So typically, you're going to get non-recourse loans, meaning you are not personally guaranteeing the loan. Not always, but a lot of the times. Okay, so every loan's a little bit different, but respectively speaking, non-recourse loans, commercial financing, this loan, the property itself is going to substantiate this loan, and the financials of the property will substantiate this loan. So it's much easier to get it. It's literally so much easier to get this loan versus buying a house, okay? Now, the equity in the deal, 35%, $219,000. Now, I know what you're probably saying, Justin, I don't have $219,000. Totally get it. We'll get into that in just a minute. Now, I'm going to also add in $100,000 in renovations to improve the property. And I'm going to show you why we would do that so we can boost the rents. Increase the rents on the property, add value to the property, you make more money. $100,000, $10,000 a unit. It's a 10-unit property, $100,000 in reno, $10,000 a unit to improve the property and renovate it. Just like flipping a house, we can flip an apartment building. I'm going to show you how. $40,000 in closing costs. This closing cost includes legal fees, title, escrow, your acquisition fee, which we're going to get into in just a minute, but closing costs into the deal. So total equity of $359,000. Now you may be saying, well, holy crap, I don't have that. I can't buy it. I know you may not, which I didn't have a single dollar, but I'm going to show you how this breaks down. Okay. So Typical deal is this 359 is going to break out like this. 10%, you can see that on the screen. 10%, okay, is you. What is that? Call 36K for simple math. 90%, now this doesn't have to be this way, but this is typical, is your investors. Okay, so that's going to be 323,000. Now I know what you're saying. Well, just stop with the negativity if you're thinking this. Oh, I don't have friends and family. I don't have people that I can rate. Yes, you do. I'm going to show you how you would do it. It's actually a lot easier to do this if you have a deal that makes sense. Remember, it's deal, debt, equity. Deal, debt, equity. Deal, debt, equity. Remember that. That's why I'm saying it 3 times, because the importance of this is critical. People with money understand one thing very, very, very well. In order to make more money, I need to move the money. I need to keep it earning interest. I need to keep it invested in things. I need to keep it going with things, which means I'm going to invest into the marketplace. That can be different types of investments. Real estate's a big one. Now, if you have a deal that makes sense, that money will find it, which is why deal, debt, equity, right? Because if you have the deal, boom, you get the loan, that's your debt, equity will find you. Every single day of the week and twice on Sundays. Trust me, I've been doing this enough to know exactly how this works. I need you to trust me that I know what I'm doing. I'm going to walk you through it. Here we go. So 10%, 90%. You're responsible for $36,000. 90%, 323 is coming from investors. Now, how would the deal structure and break down? General partner, GP, is what that stands for. Limited partner, that's your passive investors. Limited partner, right? They're not taking on the risk that you are. They're not managing the deal day to day. They are passive investors, limited partners in the deal. You are the general. You're the big dog, okay? So you're here, they are there. That's how structurally it would break out. Here's your 10% money, 36 grand. 90% money, here's their 323 grand, okay? Ownership of the deal and profit splits are different than the money in. So I am going to get 30% of the deal for bringing in 10% of the money. They are going to get 70% of the deal for bringing in 90% of the money. Make sense? So here's the beautiful part about the entire thing. Use the general partner, get to double dip. Remember this. Watch that very closely. This is why this game becomes very lucrative when you're in this position, okay? The reason why is because you're taking the risk. So if you're taking the risk and you're bringing in capital partners and they're getting a nice return on their money and you produce that return for your investors and yourself and you do a good job, you should be rewarded handsomely. That's the entire point. Otherwise, why would you do it? Okay, why would you do it? Why would you take on the risk and all these things you're talking about if you cannot have a lucrative possibility, right? Risk reward, I'm getting paid for the problems I solve. Remember that. Your income is a direct relationship to the problems that you solve. Brain surgeon makes a ton of money. Why? Fix problems, big problems up in this baby. Same thing, doctors, attorneys, right? You solve big problems, you make people a lot of money. Hedge fund managers, they make a ton of money. Why? Because they make a ton of money for their investors. You should be paid handsomely. Same thing here. If you do well, you should be paid handsomely for it. That's the whole prospect of it. So as the general partner, you're bringing in 10%. That 10% is actually invested right alongside your investors over here. So not only do you get the 70% split of cash flows and profits and everything, you get the 8% preferred return that's coming to the investors. So a preferred return, what that means is your money, if I give you $100,000, $8,000, 8% gets paid first before any of these profit splits happen. 8% preferred, pref, gets paid first, have preference before profit splits, okay? Now, you as the general partner, you get that. So you get to play game over here. You're acted just like an LP investor. You're getting all the benefits of an LP. You're literally invested right alongside them in the capital stack. You also get this. This is called the profit promote, the benefit of being a general partner. You get all of this and you get this. All of this and you get this. That's why it's so lucrative. On top of that, because I want you to be calculating this for a minute. You're putting in $36,000. Okay, $36,000. I want you to think about this for a minute. $36,000. When you close escrow, the day you close escrow, built into your closing costs, okay? Built into your closing costs right here, closing costs, in that number, dropping stuff all over the place today. In that number is an acquisition fee of nearly $20,000. Okay, day one, you get $20,000 coming out of the deal. Okay, so think about that for a minute. 36,000 in, almost 20,000 out day one. So how much money do you have in there now? Now you have $16,000. Cash in, cash out. You get an acquisition fee day one. So now you really only have, give or take, $18,000 in the deal. Okay. Now that deal is going to start producing a cash flow. So on top of that, you're going to be making $800 a month based on the projections I'm going to show you here in a minute. Okay. So $800 a month times 12, that's $9,600 a year. Okay. On, let's just call it 36,000, just for simple math. Okay. Even though it's technically less than that. Remember, you got 18,000 out, you really only have 18,000 in. But still, that's a 26% cash on cash return. 26% cash on cash return. And we haven't even talked about profits yet. And that doesn't even include this money you get. That doesn't even include your asset management fee. That doesn't even include your construction management fee for helping with the renovations and managing that process. Because you're going to get a 5% construction management fee, right, on that 100 grand of the reno. You're getting 5% of that, 5 grand. You're also going to get an asset management fee of 1% for managing this thing month to month, day to day, asset management fee. And this is based on the revenue of the property. So I'm going to show you that about $90,000 a year in operating income. Okay, give or take. It's going to be close to $1,000 a year you get on top of that, right? So do you see how you're getting all of this money? So just from a cash on cash perspective, okay, you're getting the 26% over here. Guys, that doesn't even include your playing ball over here. You're still getting this. Your 36,000 that's over here is getting an 8%. Plus you're also getting the 70%. Plus you're getting this 30% over here. Plus you're getting the acquisition fees, plus the asset management fees, plus construction management fees. Do you see where I'm going with this? This is why you do it. This is why multifamily kicks the crap out of single family, kicks the crap out of flipping at the end of the day. And we haven't even talked about the tax benefits yet. We're getting to that in just a second. We're just starting the ball game. Because the tax benefits are going to blow your mind away. Okay? Going to blow your mind away. Because when you see the tax benefits, it should be a crime. It's legal, but it should be a crime. But this is kind of how this thing stacks up. But I'm just kind of walking, and this is just a simple, guys, it's a simple $625,000 deal, right? Which for your first one may seem like a lot, but it's really not. It's really not. I mean, this is a deal we just did recently, $13 million, right? And I can break this whole thing down for you here too, right? But for simplicity, I'm walking you through this. So how would you underwrite, right? How would you underwrite a deal? So let me go back to sharing that pro forma and show you what's going on. So we have two different templates we use. We have a basic pro forma, and then we have a super elaborate one for the big deal, right? But for a simple one like this, you can see it up on the screen, Garden Grove, okay? Little $625,000 deal. You see, this is all plug and play. Everything here in blue, plug and play, it pops out everything else for you, okay? Plug in your interest rates, your down payment, number of units, all that stuff, right? Closing costs. You see all this stuff in here that we already just put up on the screen for you, but it's in here. You're going to plug in the rents for the property. You're going to plug in the expenses on the property. You're going to get all of this information is going to come from the operating memorandum. Let me share that with you because we just showed that just a minute ago. That's this little marketing piece that comes from the broker. Now you may be saying, well, Justin, how do I find these deals? Great question. That's what we're going to talk about here just shortly, but I wanted to kind of break something down here for you. Okay. But I want to show you this pro forma real quick. This is the analyzing part. So you're plugging in all the numbers, it's populating. Everything in blue you put in, everything in black is hard-coded with formulas. And it's giving you data points and all that stuff. So this property is going to produce about a 20% annual return from a property level, right? Property level. That's not your level. Because I was showing you up here, you're making nearly, you're probably making over 35% cash on cash return on your money. It's stupid because, it's actually, guys, it's probably close to 100% just because all the money goes in, goes out. I can break all that down for you, right? And the waterfalls and all that, but I'm not going to get into too much craziness here. But you see where I'm going with it. You analyze it through these pro formas. We have them. You can have them. Not a problem. But how would you find the deals? So let's go back. Once again, let's reference this. Right? We talked about this in the beginning. You got to find the deals. So how do you find the deals? I'm going to give you the website. There's plenty of them. But you need to remember these things. On and off. On and off. You may be saying, what in the world? On market, off market. On market, off market. Right now, about 40%, only 40% of all the deals you will see that are actually available are on market. You can use the website crexi.com. That'll pretty much get you this 40%. It'll show you all the deals on the market in the United States of America, for the most part, that are on market. Crexi.com, free website. Go use it just like Zillow and Realtor.com, but this is commercial real estate. Commercial real estate. Crexi.com, sign up, free account. This is going to show you this, and that's great. But that's not going to get you the bling bling. The real bling bling is here. Because that's where commercial real estate's really done. At least 60% of all the deals in the United States of America, commercial-wise, off-market or pre-market, as they call it. So then the question is, well, Justin, yeah, I get it. I want those. I totally know you do. But you're never going to get them unless you learn how to play the on-market game. You got to start here to get to here. Start here to get to here. Start here to get to here. You have to do a few deals in the on-market space to get the track record in the market and get the goodwill with the brokers in the market in order to build the relationships with the players in the market to then start to see this game. You will never, a new investor, a novice, will never see the light of day in this space unless you learn to play this. It'll never happen. So this is why you may be getting frustrated. You're like, yeah, I know all the deals are there. I know they are, but you'll never see them. So you're only going to play ball here. You need to do a couple here, then you get to here. So stop asking people for off-market deals if you're new, because there's no way on planet Earth a broker that's doing deals in the market is going to give you, as a new person in the market, an off-market deal. It's never going to happen. They will never risk their neck like that. They need to know that you can play ball and you can execute. So you got to play ball and execute up here first to get to this stuff here. That's how you find the deals, and you're going to do it on that website. Okay? This is how it's going down. And once you master a couple deals in the on-market space from crexi.com, then you're going to start to build relationships here to land this. Does that make sense? This is the reality of the world. Because how you find the off-market deals is brokers, direct. This is how I did it. Every single one of the markets we're in the United States right now, I went out there into these markets months in advance of us looking at deals, and I started to build the network. Got on the ground, knew where's the good areas, where's the bad areas, where should we buy, where should we not? Met with the brokers. Hey, how you doing, man? Shake your hand, pass a business card. What's going on? And this is if you're doing stuff out of your backyard. If you're doing it in your local markets, awesome, even easier. But you need to get to know the players. You got to shake hands, belly to belly, eyeball to eyeball. It's a human sport. And you got to build those relationships. And the only way you're going to do that is execute here. So that way you have the goodwill to go here. And that's it. And there is no rocket scientist way about it, but you're not getting this. It ain't going to happen. You're going to be peeing up a rope trying to do that because there's no way a broker is going to give you that if you not learn this first. Make sense? Okay. Awesome. So that handles finding the deals. Now let's talk about analyzing, which we just did. We broke that stuff down. You use the pro formas. That's how you're going to analyze the deals. And I'm going to show you another one here just in a moment on a bigger level. Okay. Because I want to show you an actual deal, actual case study of a deal that is ours that we did a few years back in Kansas City, Missouri. So that was a $625,000 deal. Now I'm going to show you this one. So this was a little 31 unit. Now, for most of you, you're saying 31, it's a lot. I get it. It was a lot to me at first too. Now it's a little deal because we're doing 100 plus, 150 plus, 200 unit type deals now. But we started here. Okay. So what did this deal look like? Here's the financials on it. We're going to walk through it. Okay. Bought it for $1,585,000. Put $300,000 in renovation money into it. We had $115,000 in closing costs. So for round numbers, let's just call it $2 million total in the deal. Got $1.4 million loan. $600,000 in equity. Now you may be saying, okay, well, that's a lot of money. I get it. We brought in 10%, 60 grand. We raised 540 from our investors, friends, and family. We're going to get into capital in just a minute, how you raise the money. But this is how it went down. 10%, 90%. Now, I want you to understand this. $60,000 cash in. Pay attention. Remember I talked to you about the fees that you get for being the general partner? 3% acquisition fee on the purchase price. $47,000. $60,000 in, $47,000 out day one. The minute we closed escrow, they're going to like money pass itself in the sky. Okay. So I had $13,000 in physical cash in the deal. Now I'm making about $1,000 a month on top of that as an asset manager on the deal. Now you see that's $12,000 a year. Now, within 1 year, I've already got all my money back, 100%. Now we're playing with house money. That doesn't even include my 30%. Remember we talked about splits? 30%, that's another $2,100 a month. That doesn't even include that in year two, we refinanced the deal because now we'd renovated it. We had a new value. The value is higher. So we were able to do a cash out refinance, literally returned all the equity. All $600,000 came out, paid me back, paid all the investors back 100%. So at this point in time, now we're really playing with house money. So I got my $60,000 back. This is all tax-free money. When you do the refinance, it's all tax-free money. Okay. And I'm expected to make another close to $400,000 when we sell the property. So I want you to compute this for a minute because I think you're getting it. As the general partner, I put in 60 grand, got $47,000 out day one, plus $1,000 a month on top of that, plus the $2,100 from the cash flow. Now this doesn't even include my portion over here of the 70% and the 8% pref. I didn't even calculate that yet. That's on top. We're just having fun on my side of the game. $2,100 a month in free cash flow on the deal. Refinance it. I get all my money back. It's all tax-free money. I can go play ball with it. And I'm going to make almost another $400,000 when we sell the deal. 60,000 in. But I got all, I mean, you see where I'm going with it? This is why this makes sense. This is why it's so lucrative. If you do it right, but you get to remember, you get to make the money because you're kicking ass and taking names. You're finding good deals. You're making it happen. You're producing for your investors. So you should be paid handsomely because your investors are being paid handsomely. Your investors are making between 18 to 22% a year on their money. So for someone, if you came to me and I'm an investor and you're trying to get me to invest in your deal and you say, hey, Justin, I have this deal. You just give me $100,000 and I'm going to give you $18,000 a year on that at 18%. Okay. and you're passive, you don't have to do anything. You just collect a check. Okay, great. 18, where are you going to find that in the stock market? Best of luck, right? That's highly risky. It's not attached to a physical asset. You own a physical real estate asset, 31 units, Kansas City, Missouri, or wherever it may be at. Physical real estate, touch, feel, go look at it every single day if you want. You have ownership in that. Very, very valuable, because this is somewhere, hey, maybe they're putting 100 grand here, 100 grand in crypto, 100 grand in stocks, 100 grand in my 401k, 100 grand over here, whatever it may be, right? But they're investing in real estate too. So if you can build those relationships with people, that's how you do it. We're going to talk about capital raising in just a minute. But you see how this works. This is the no bullshit. This is how this goes down. This is why you can make a ton of money doing this if you produce great results, right? Find good deals, analyze them correctly, right? Put them together in raising the capital, close escrow on them right, manage them correctly. It's those 5 things I talked about in the very beginning. But this is how this goes down, okay? This is how this goes down. So let's talk about raising money for a minute. Let's talk about raising money. Right back here. We having fun yet? I get animated because I get excited. I love this stuff. Love it. Love it, love it, love it. Could talk for years on it. Let's talk about raising money. These are the 4 groups that you're going to raise money from. The 4 groups that you're going to raise money from. You're going to start here though, right? Friends and family and high net worth individuals. And then how do you do that? Okay, you put together what's called a pitch deck. And so let me walk you through this for a minute. Let's presume you found that $625,000 deal in Huntsville, Alabama. Now you've analyzed it, you've put it together, you've made an offer, you've locked it up. Now you're kind of getting ready to go into escrow. So now at this point is what we teach in our mentorships, and we handhold our students through this whole process. You're not having to do this alone. But now you have it locked up. Now you're going to start kind of putting the pieces of the puzzle together to now go raise money, get the loan, all these little pieces that kind of have to come together. It seems like a lot, but it's really not. But once you understand the process, you get it to flow. But you're going to put together a pitch deck. And that pitch deck is going to explain the property. It's going to talk about its location. It's going to talk about, the different things, the benefits of it. It's going to talk about all the returns. It's going to go through the financials, like all this stuff, right? Now, you don't have to worry about creating all this stuff. We have all these templates. This is what we give to our mentees in the programs. We have all the templates. We've done all the hard work. It's just kind of a copy, paste, repeat thing at this point, right? All of these templates, right? To kind of break it down, walk investors through, show investors what they get. Hey, if you give me $100,000, right? You give me $100,000, this is what you get. Year 1, year 2, year 3, year 4, year 5, this is what you get. Preferred returns, profit splits, all this other stuff. I know there's a lot of writing on the board, but we show through the templates, so it makes it a lot easier to explain things to investors, to people. You send them the pitch deck, and you say, hey, John, review this. Here's some summary bullet points. I'll get back to you. And then boom, it goes out. They review it. As long as it looks good, it makes some sense, and they believe in your projections on the deal. Raising money is not that hard. It's just not. The reason why is because you have in your head that people don't want to give you money because you're new. What you're not understanding is that people with money want to give you money if they believe in the deal. So this goes back to deal, debt, equity. Deal, debt, equity. If you have a good deal and you seem like you know what you're doing, so you may be new, but you can partner with people. This is why our mentees come in and we kind of help them out. All this stuff goes down because it's really important that, if you don't have a track record, you are attached to people that do, or you're being mentored and taught and coached along the way with people that do, i.e. us and what we do with all of our students. But this is how it goes down. Pitch deck. So that's how you're going to entice an investor, is through a pitch deck that explains the investment, explains the property, explains what they make, all of that stuff to get them excited to say, yeah, I see this. I love the property, love the location. I believe in you. Great. Here's my 50 grand. Here's my 100 grand. Here's my 25 grand, whatever it is. Okay. So that's how you're going to raise the money. Friends and family, high net worth individuals. So just to give you an idea, friends and family, you're going to be somewhere between 25,000 and probably, let's call it $100,000 check size. Okay, $25,000 to $100,000 check size. High net worth individuals are probably going to be 100K to 500K checks. You may even get a 1 million check here. Okay, somewhere in there, maybe 1 million plus, possible. Private equity funds, private equity firms, these are people that are going to come in. It's a professional institutional group. You're not going to be playing in that in the beginning, because these guys are writing you $3+ million checks, right? 3 million plus checks. Check size here is $3 million or more, probably. Plus. Family office, that's the FU money, right? I need to go raise $30 million, $20 million, $15 million in equity. I'm playing ball maybe in this space, but you're not going to deal with any of this. So I focus here because this is how we started. Just, once again, just to give you an example, going back to this, on that deal in Kansas City, right? Perfect example. We raised 600 grand. 540 of it came from friends and family. This 540, just so you understand this, is 7 investors. 7 investors made up that $540,000. Some were 25, one gave us 200. That was a high net worth. 25, 50, 75 were like a majority of them. Those were friends. And then a high net worth individual gave us 200. So we had a mix in there. 7 investors made up this 540. We brought in 60 grand. Done. So getting the loan, the bank threw money at us. They threw it. They were like, property's great. Makes sense. You're buying it. Just boom, here's your money, baby. Have a great day. Because we were banking on the property's financials. And you're putting in the equity, right? You're bringing in the equity. So great. If you don't perform, we get a great property, right? And you're bye-bye, and we have a great asset that's worth a lot more. Is this property right now, FYI, $3.6 million. $3.6 million today. Keep in mind, we've gotten all our money out of it already too. So you kind of are watching how this is working, okay? So that's the raising money part. And that's how you would do it. And we teach all of this stuff, like A to Z. And we provide all the tools, all the templates, everything. You're not having to, other than just copy, paste, repeat, and do what we tell you to do. You just need to go execute. And you can absolutely do it, right? Find the deals, analyze the deals, raise the capital, close escrow, manage. That's it. 5 things. That's how you do apartment buildings. And you can be a multi-gazillionaire, millionaire, bazillionaire if you want. Okay, it's all up to you how big you want to go. You want a couple of these? Fine. You want a lot of them? Awesome. That's where we're headed, right? We have 527 plus units right now, $110 million in assets. I'm going to 4 billion in 10,000 units, and I will get there. And it's happening. And it's happening with great people like you, because people, partners, students around the country that we're partnering, we're doing deals, and we're growing because of that, because maybe someone wants to bring an opportunity like this that we can help partner on. We would love that. Helps us see opportunities we otherwise wouldn't see, and work on opportunities that we otherwise would not have. So extremely valuable. Okay, let's go back to the next step of it. See how we're doing on time here for everybody. Hope this is super valuable. Right around 40 minutes. We're probably going to go an hour here, okay? Probably going to go an hour. We're going to talk about the closing stage. Closing stage, why this is so important. As part of any of the stuff we give out, investor checklists. We have due diligence checklists. How do you find emerging markets? How do you find markets to do deals in? All this stuff. How do you do due diligence on closing escrow on the property? Right? All this checklist stuff that you got to go through. We have all done and dusted. when you do due diligence, both financial and physical on a property, to make sure you're not getting into a money pit, we have an apartment due diligence checklist. All the team, the inspectors, everybody you need, done, dusted, we have it for you. All the due diligence you need to make sure that you cover so you don't get into a money pit, we have covered. We do all this stuff, right? This is so you get into the financial and physical side of it. So giving you, and I don't want to, I'm not going to get too crazy with all this stuff because it's a lot. So I'm going to touch on it from a 10,000 foot level for you. Okay. But on the financial due diligence side, the type of financial documents you're going to be getting from the seller when you're in escrow. They call it a T12. That's a profit and loss statement for last 12 months. You're going to get that. All the utility bills for the last 12 months. Any copies of contracts with any of the vendors that have been doing work on the property. Copies of all the leases for all the tenants in the property. Verification of the down units. Loss to lease. These are all just little terms. We have glossaries for all this stuff. Don't worry. It's a lot of language you're probably hearing going, what the F? Don't worry. Loss to lease, bad debts, non-paying tenants, verification of deposits on any rents that are there, verification of RUBs. These are called utility reimbursements. On an apartment building, tenants reimburse a percentage portion of utilities for water, sewer, right? Any of that stuff. They pay their own gas and electric typically, cable, and then for water and sewer, a percentage, pro rata percentage based upon square footage and number of residents in. That's called RUBs. Verification of capital improvements and expenditures. So anyhow, list of all the stuff. So you're not having to think, do I have all the documents? Trust me, this is trial and error by losing money. So now you don't get to lose it. That's the good part. Here's a list of questions that you would send over to the seller or the seller's representative, the broker, prior to going into contract. And all of these questions have been put together because of mistakes and errors and trial and error that we have made over the years of things. Oh, we didn't think of that. Boom. Now it's a question. So that way we get an answer on that before we go into contract with any sellers. Okay. And the reason why this is important, unlike residential real estate, where you have contracts put in place by the state, typically that you're buying in, that have consumer protections in them for recourse if the seller doesn't disclose things, is not forthright, isn't acting in goodwill, and all this other stuff, right? You have protections under the consumer laws in that state, under the contracts for a residential real estate purchase, buying a home. It's the wild, wild west in commercial real estate. It's good old cowboys and cowgirls club. So it is buyer beware. Your job when you're buying a commercial building is to know what you're doing and have the due diligence and have all the stuff to ask the right questions, to inspect the right things, to do. It is on you. You do not have a ton of recourse later unless you have all of this in place and this goes into the contract. So you have recourse that seller, you said X and it was Y. So now you have the ability to go back and, kick them in the butt. But it is your job to do all of this stuff in your inspections, in your questions, in your due diligence, and all of this. It's on you. So this is why we put all of our students, everybody through this. So that way you have it all. You don't have to think. We're doing everything. And we walk everybody through it every step of the way. Because once you do this once or twice, you're like a pro. You're like, oh, okay, I got it. Like it was scary, but now it's not. Scary, but now it's not. So all of this stuff, your team, all the due diligence you need to inspect, everything, right? Because that's part of the closing process, right? That's a huge part of the closing process. So that way, you get into a deal that makes financial sense. And you've done all of your inspections. You can ask for, maybe credits back because you inspected the roof and it's falling apart. So you ask for a credit. So it's all negotiations. And we walk everybody through this stuff. So it's really important. But that's the closing process. Financial and physical. Financial and physical due diligence on a property. So no different than that 31 unit in Kansas City or the 10 unit that would be in Huntsville, Alabama, or other properties that students and mentees are working on around the country. The minute they go into escrow, we're right alongside them because they're asking a million questions, especially if it's their first time. And we're walking them through it. Boom, 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 boom. This is what to expect. This is how you do it. This is all that stuff. So that way you go through that first or two, one or two deals, and now you're a rock star because now you get it, right? You went through, but you didn't have to learn all this stuff by losing a bunch of money. You learn this by having a holding hand, helping hand. Closing the escrow. All right, so we've gone through finding. How do you find them? How do you analyze them? Gotta love this stuff. Technology. There we go. How do you analyze them? We've gone through how you raise the capital, closing process. Okay, closing process. Similar to buying a house, you're going to have a title company, attorneys doing the contracts, but then all your inspections are going to go down. Typically, the inspection period's about 30 days, all of that stuff. So you have inspections for 30, and then you have 30 days of closing. Maybe you have an extension. So a typical time frame to close a deal is usually going to be, about 30 to 90 days. Let me show you this real quick. This is actually a good stepping stone here. This is a letter of intent. Basically an offer. This is how it gets done, okay? All right, letter of intent. When you're going to make an offer on a property, going into the closing phase now, when you're making an offer on a property, you're going to send over a letter of intent. We have templates. This is all templated. People that are in our mentorship get this. And then we walk them through all the language, but it's templated. So you're just going to change a few things, then it goes out. You're going to make a lot of offers on a lot of properties in order to get one. That's just the way that it works. It's a numbers game to find the right deal. But letter of intent goes out to give you an idea on the closing time frame, right? Due diligence. So we have 28 days in here, 60 days total closing with a 30-day option to extend, stuff like that. So a total of 90-day potential to close this deal. And it's all done in the letter of intent. And then from the letter of intent, once it's signed by both parties, buyer and seller, you go into a contract. And that's the process. And then once that's in, all the timelines are in place. So this is the process for closing. Letter of intent, like we just said, then it moves into contract. Usually it's a 10 to 14 day window between agreed upon the contract. Then you have all your timelines for your due diligence that you're going through, right? Inspections, financial, all that stuff. You're at this time during the finance side, you're getting your debt and your equity. So you're pulling your loan together and you're pulling your equity together all during that timeline. But 60, 90 days to do all of this. It all works. Doing some legal, your inspections, all that stuff's all it's going down in the closing phase. So these are kind of the steps of your closing phase. From letter of intent, timelines, finance, legal, inspections, all that stuff is going down. Okay. And we provide all the templates and documents and everything for that. But that's kind of your closing process. All right. So now we are leading on to my best part to finish this off. Managing operations. So I'm an operations guy. I don't know why I like it, but I do. I like getting into the weeds, right? I grew up digging ditches on my dad's construction sites. And it just, for me, I love that. I love getting my hands dirty. I love kind of learning things, getting into the detail. It's just something that it's kind of enjoyable for me in a weird way. So I love the operational side. I'm really good at analyzing property operating statements, getting into the income and the expenses of them, finding ways to make or save more money, make or save more money, make or save more money. Okay. So managing the deal, managing the deal. Let me get into a blank sheet. Whew, I love it. This actually leads into the management side. This is really important. Okay. So when you look at these financial statements from these properties, and we showed you the pro formas and all that stuff and how it all breaks down. Every single income property, doesn't matter, okay, whether it's a 2-unit deal or a 100-unit deal, doesn't matter, okay? Every single one's going to follow this exact same financial pattern. Gross rents, how much potential money can this property make? You're going to take out economic loss. So this is what physical vacancy on the property, bad debt, meaning tenants not paying rent, loss to lease, which is the difference between a market rent, maybe being $100 a month, and maybe you're getting $80 a month. $20 delta, loss to lease. Okay. Concessions. Maybe we're having to give $50 concession to move in. Okay. That's economic loss. Typically, depending on your market, it's going to be anywhere total economic loss between 5 to probably 12%, depending on your market. That leads you to operating income, EGI, effective gross income, operating income. These are just terminology things. Don't worry about them. Then you're going to take out your operating expenses. This is insurance, property taxes, repairs and maintenance, property management fees, general administrative, marketing, on and on and on. Contract services for landscaping, on. Yeah, there's a list that you'll see in the stuff, but simply put, operating expenses. This normally runs anywhere between 30 to 55% of this number here. Okay? Depending on the age of the asset, right? Newer assets, it's lower. Older assets, it's higher. 1960, 1970 product, you're here. Brand new construction, you're probably here. Okay, give or take. Now, once you take out all of this, you're going to get to this beautiful number called a net operating income, NOI, net operating income. Now, this is a very, very, very critical number. And this is a number everybody talks about all the time. You hear it, you probably heard it before, seen it online, net operating income. Why is this so important? Because the value of your property is determined by the net operating income divided by what's called a cap rate. Net operating income divided by a cap rate. Let me give you an example. Let's say the net operating income on the property is $100,000 a year. And a cap rate, which is determined by the market, right? And brokers determine this, sales and comps determine this, just general market determines this cap rate. So you don't have to figure it out right now. But let's presume for a minute it's a, I don't know, let's call it a 6 cap for simple math, okay? So NOI, cap rate. My value is that and that. So this is a $1.7 million building for simple math. I'm rounding up. $1.7 million building. Now, watch how this works. Let's say for a minute, I simply increase this 10%, right? I'm able to increase the revenue or decrease expenses. Either way, I mean, net operating profit for the building goes up 10%. Okay? Same cap rate. So literally, by increasing 10%, I just put $200,000 in my pocket. I mean, that's less than $1,000 a month. Increasing rents, decreasing expenses. I mean, you see how this works. You see how this works. I mean, that's why the power of net operating income is critical, right? It's because it's massive. It's like a 20 times ratio. It's a 20 times ratio because if I can increase $1,000 a month on a property, I mean, think about that. If I go $1,000 a month on a property, that's $12,000 a year. I'm increasing that, right? Take that over, let's say a 5% cap rate, which is pretty common. I was inflating it at 6, but every market's different depending on where you're at in the cycle. The $12,000, right? I just added $240,000 to the value of the building by increasing the net operating income $1,000 a month. Do you see how freaking rad this is? Sorry, but you see how powerful this is. Okay, so operations and management. So I showed you that. Property managers. They all suck. Excuse my language. They all suck. They all suck. I don't care if you're a property manager watching this. On average, you all suck. And I know you're going to get a little upset with this, but I'm going to explain to you why you guys suck. Okay? I will outperform any property manager every day of the week and twice on Sundays. And there's a reason why. There's a reason why. Most see, you need them. That's the hard thing, is you need the property management company. But this is where asset management comes in. You manage the managers. You manage the managers. And yes, that means a little bit of micromanagement. You have to if you want to make some money. Most property managers suck. So you have an asset manager, which is us and our company, managing the property managers who are then managing your real estate asset. Okay? Most PM companies, the only way they make money they have to be a mile wide and an inch deep. Okay? They end up getting spread way too thin. Because it's a small margin business. So the only way they make money is to have a crap ton of properties they manage, and then they don't grow their resources and staffing accordingly as that expansion happens. So what happens is as they get bigger and they take on more assets, they tend to grow too quickly, and then they start dropping the ball everywhere. Because there is no way any good PM can manage an asset at the level it needs to be managed correctly, especially if it's a non-stabilized property that still needs either construction, renovations, maybe it's got problems in it that they need to move the needle on it, whatever it is. Like, they're just not able to, like, boom, get in there like a ninja and make it happen. So this is where you as the asset manager have to come in and help guide and direct the ship to the property management company, because most are just not that good. They're just not. I wish they were. I wish they were. I really wish they were. And some are. So I'm a little bit biased at the moment, but most PM companies are not that good. And I know you probably look at me if you've dealt with them and you're like, oh, guys, that guy's, yeah, you're right. They're not, but that's why. A lot of properties, mile wide, inch deep. They cannot properly see and manage that asset the way that it needs to if it needs help, right? To really have it make money. So you got to get in there and understand your reports and your financials. To finish off on this, there are 4 reports. And if you manage these reports, your property will kick ass and take names. If you do not manage these 4 reports, your property's financials will show and you'll lose money. Okay, you ready for them? Available units list. Work order summary. I'm going to explain this in a minute. Delinquency list. Expiring leases. Okay. These are for today. This shows you what 90 days from now looks like. So by managing these 4 reports correctly, I can tell you exactly how the property is operating today and exactly how it's going to look 90 days from now. It is not rocket science, and most PM companies don't understand how to manage this correctly. The availability list shows you all the units that are vacant and available to lease, available units list, all the units that have given notice to vacate, all the units that are pre-leased, meaning vacant but leased, they're moving in soon, all the units that are under eviction, and lastly, any down units that maybe are in renovation or make-ready status, okay, that aren't ready yet. Available units list. You manage this kind of assembly line on your property, and you know where things are at. Where, you know, what units are ready to lease, what units aren't, what units are coming, what units aren't, what units, right? You get where I'm going with it? Available units list. Very, very, very critical. Work orders. Heads in beds. Your tenants are your customers. Now, there's always tough tenants. I get it, right? Property management's hard. There's always tough tenants. There's always pains in the asses out there. I get it. But heads in beds. Your tenants are your customers. You treat them with respect, no different than a hospitality business and a hotel, right? 90% of the time they're right. 10% of the time they're full of shit. right? But that's how it works. I mean, in your mind, and you treat them with respect and you help them and you make sure that they're being handled correctly and you're handling these work orders. If there are repairs that need to be done on your property, you want them responded to in 24 to 48 hours by your staff. You want them completed in 7 days or less by your staff, unless there's some arduous reason why they can't. 7 days or less, done. Completed and closed. Responded to in 24 to 48 to say, hey, Mr. and Mrs. Tenant, we hear you, we see you, we're coming in to take a look at it. We can either get it done immediately or, hey, it may take a few days. Either way, you manage this, you have happy tenants. Happy tenants do what? They renew their lease. They don't expire leases. They renew, they stay. They stay. They say, gosh, this is a great community. You know, unless there's a life event that forces them to move, right? Job, family event, life events that cause change, fine. But if there's not, and they're just moving because they're unhappy and pissed, it's 9 times out of 10 because you don't respond to repairs correctly, fast, efficiently. And your staff is not on it like white on rice. So work orders. If there are a ton of work orders on our reports, I freak out. And I say, guys, why has this one been on there for 3 weeks? That tenant's probably pissed by now. Why? If they don't have a good answer, get your head out of you know what. Let's go. Let's go. Don't give me excuses. I want execution. I want execution. I want things done. Bull BS. Work orders are critical to saving leases and getting renewals. Because every single time somebody moves out of your property, it is going to cost you a minimum of $3,500. Every single time a tenant moves out of your property, and I don't give a rat's you know what if it's a 2-unit duplex or a 100+ unit multi-million-dollar apartment complex. $3,500 minimum. Lost rent, turnover cost, fees, commissions, marketing. I mean, you name it. I guarantee minimum $3,500. So do you think it makes sense to focus here and focus here to keep heads in the beds, even if you need to give them $500 as a little, hey, maybe you don't. Maybe the market doesn't need it, but sometimes it does. You do the math. Remember this number. Remember that number like a hawk, okay? I get animated. I like this stuff. All right. I love operations because I can dive in and I can see a property like that. I can tell you whether this thing sucks. Property management sucks. I can figure it out pretty quickly and go through the staff and say, this person, nope, yes, move, let's go. Let's execute. Let's go, right? That's it. 4 reports, guys. I can come in and look at your property with 4 reports and I can look at all of them. I can tell you how your property is doing today and how it's going to do 90 days from now. And I can tell you where your staff and your processes are not working, software, systems, operations. You give me a couple days on a property and I'll have that thing dissected. Okay. So those are the 4 reports on your management. You watch these, you asset manage your deals really, really well. That requires asset management over the PMs. There are some really good property management companies, but they tend to be at the higher levels. They're the big companies, right? RPM, Asset Living. These are big national brands, right? But they're only dealing with 100+ unit properties. So you get into the smaller weeds and the mom and pops and the local level stuff, you've got to stay on them, you guys. You got to stay on them. And we teach this stuff in the mentorship, how to do this correctly. But honestly, it's 4 reports. You master these 4 reports and how to read them, your properties will hum. You don't master those reports and you don't know how to read them, your properties will suck. It's that simple. This is it. This is it. So I hope this was helpful. We're actually over an hour now. I don't want to keep everybody too long. But just to kind of summarize what we went through here today, how to find the deals. Okay, how to find the deals. How to analyze the deals. We roughly analyzed one, walked you through the numbers, how to raise the capital, how to close escrow on them, and then lastly, how to manage those properties. But this is how you buy apartment buildings. This is how you buy apartment buildings. If you want to dive into this, if you're really interested in getting into this game, which I highly recommend you do, if you want to grow real wealth, like FU money type stuff, this is it, right? We own mobile home parks too, storage facilities, mobile home parks, apartments. That's the 3 asset classes we're in. But apartments are our bread and butter, hands down. You gotta remember, people need three things. They need food, water, and shelter. Food, water, shelter. Food, water, shelter. That's it. Food, water, and shelter. And if you nail these three, boom, 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 those five things to buy your apartment buildings, that's it. But people need food, water, and shelter. They got to live somewhere. They either own or they rent. And we're moving into a renter nation type scenario, so got to move the needle. More people are going to be renting than buying in the future. Trust me, we're moving into a European model. You're going to see that happening, and the numbers are backing it up when you're actually looking at home ownership rates dropping, continuing to with cost of housing, inflation, all those other things. It's not going to get any better anytime soon. Prices will continue to rise as interest rates drop, and it'll all fluctuate. But more people are going to rent than own for the mobility as well, not just for the financial side, but the mobility of movement. You'll start to see that as well. So critically important that you master this and get into the apartment space, right? You know, you want to do storage facilities and you want to do mobile home parks, cool too. We love those. And I understand that quite well too. You flip houses. I've flipped many houses. It's a great transactional game for capital, not a problem. Don't really do the wholesaling game that much. So you can be a deal finder and stuff too. A lot of our students that are getting into it, they're helping find deals around the country too. We love partnering. That's actually that's all the whole purpose that we created the entire community was for that. So we could help them, they help us, everybody helps each other. Partnerships are critical when you're doing multifamily. So I hope this makes sense. Click the links herein. I'm going to actually put it into the chat right now. That is going to allow you, if you want to set up a strategy call and do this and kind of learn the game of apartments. We have it in here. Well, it's not here at the moment, but it was. Yeah, force quit this thing real quick. So yeah, if you are looking to learn the apartment space and you want to get into it and you want to kind of, hey, say, like, I would love to, and keep in mind, when we do our mentorships, you're getting me just like this. You're not getting random hired coaches that aren't doing this stuff, that are not executing in the marketplace. You're getting me. It was actually one of the critical pieces to me wanting to do any of this stuff. I never planned on coaching or teaching or doing any of this stuff. It actually came organically by people approaching, saying, Justin, like, we see what you're doing. We love your approach to explaining things in layman's terms, taking complex subjects and explaining them very concise and simple manner. And then hand-holding us. Like, you do a great job of that. I was like, I didn't really expect that. But it's come that way, which has been amazing. And I'm learning so much. And then I'm seeing the benefits of how giving back, helping others, helping other people acquire buildings and wealth, and how that actually pays itself back to us through them actually finding deals and us partnering together all around the country in markets we never been to. Great. Deals we would have never seen. Great. So now I can invest in your deals. You can invest in ours. It's a massive community of investors. That is really what it's about. An active investor community, well beyond the teaching stuff. So let me put up into, you can have your call. What in the world? It was all in here, and now it's not. Hold on one second. Stand by, please. Here we go. So I want to give you guys this link if you want it. Sorry to hold you on here, but this is if folks, if you want to set up a free strategy call with my team, then we can walk you through kind of where you're at and where you want to go. We will do so. And that way, you can see if it's the right fit for you, right? And see if mentorship is a good fit for you. Maybe it is, maybe it's not, but either way, you'll be set up in it. So here's your link coming into your chat right now. You can click that. It'll launch you to a page. There's a great little video on there that actually has some of this stuff in it too. You can book a call right there with my team and I. And it's a free complimentary strategy call to understand where you're at, where you want to go, and see if it's a good fit. And it's an incredible program. You'll see it all in there. I want to I'm not going to sell you or do any of that stuff. I'm not a salesperson. I'm an apartment guy. So appreciate your time. Thanks for coming on to this kind of live event for the Multifamily Millions today to kind of get your information and what we do in apartments. So until next time, take care. Talk to you soon.